We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on EXC. Exelon Corporation, a major player in the energy transmission and distribution space, is seeing some solid investor confidence, and it's interesting to dive into who actually owns the stock. Right now, a huge 84% of Exelon's shares are held by institutional investors. This includes big players like asset managers, pension funds, and mutual funds. When you have that kind of institutional backing, it gives the company a certain level of stability, but also means that the stock can be more sensitive to moves from these larger investors. One of the most significant players is the Vanguard Group, which owns about 13% of the shares, making them the largest shareholder by a wide margin. This is a big deal because institutions like Vanguard tend to have a long-term view on investments, which signals to the market that they believe Exelon has staying power. On top of that, there are several other large investors holding a chunk of the stock, which means that Exelon's future could be heavily influenced by their decisions. What does this mean for the everyday investor? Well, institutional ownership like this usually adds a layer of credibility to a company. These big investors typically do a lot of homework, so their interest can signal strong prospects. But it also means that Exelon stock can be more volatile if these institutions make big moves. For example, if Vanguard or another large holder decided to buy more or sell off a chunk of their shares, it could have a noticeable effect on the stock's price. Right now, Exelon looks like a stable pick with a solid foundation, bolstered by the backing of these institutional investors. With the stock up about 1.04% today, it's clear that investors are feeling good about its trajectory, especially with the utility sector stability. The key for investors looking at Exelon will be how it continues to navigate its future in the energy space while staying in favor with those big institutional backers. Our review on FE. FirstEnergy Corporation has made a noteworthy move recently, announcing an internal reshuffle aimed at improving efficiency and sustainability within the company. The plan involves reducing its workforce by under 3%, or about 200 employees, with many of those affected being reassigned. This isn't a dramatic restructuring, but rather a strategic alignment to make the company more agile and customer-focused, which is always key in industries like utilities. For investors, this shift suggests that FirstEnergy is taking a disciplined approach to cost management while focusing on operations and maintenance. It's all part of a broader strategy to streamline the organization and ensure it's better equipped to meet future challenges. By placing more responsibility closer to customers and regulators, it also signals the company's commitment to enhancing accountability and making sure they're more responsive to market demands. From a stock performance standpoint, the market reacted positively to this announcement, with shares rising 1.55% today. That's likely a sign that investors see the potential for long-term value in these changes. It's also worth noting that while a workforce reduction can sometimes be viewed negatively, in this case, it looks like FirstEnergy is using this as an opportunity to optimize its operations, which should ultimately support its bottom line. So, for investors keeping an eye on the company, this organizational shift is worth noting as part of a broader strategy to keep FirstEnergy on the path toward long-term growth and efficiency. It's all about positioning itself to handle future demands while being more adaptable and cost-conscious. 2 things that can pay off over time. Our review on ABBV. AbbVie Inc., a global biopharmaceutical company known for its wide range of products from immunology and oncology to eye care, has been catching the eye of investors lately. Over the past month, the stock has outperformed both the S&P 500 and its industry peers, which is a positive sign for those keeping tabs on its potential. For the upcoming quarter, AbbVie is expected to see earnings grow by about 8.7%, although analysts have slightly lowered their projections in recent weeks. Still, the company's overall outlook remains strong, with an expected 21.5% growth in earnings for the full year. Revenue is also trending up, with the company forecasted to see around 5% growth in the current quarter and even stronger growth expected in the next couple of years. AbbVie has a solid track record of exceeding earnings and revenue estimates, which always boosts investor confidence. However, right now, its stock is priced in line with its peers, meaning it's not undervalued or overpriced. It's kind of in the sweet spot for those looking for steady performance without major fluctuations. The stock was up 1.27% today, reflecting investor optimism despite some minor downward adjustments in earnings expectations. So, while there's no huge surprise here, AbbVie continues to show solid growth and potential. It's a reliable option for long-term investors, especially given its consistent track record of beating expectations and strong positioning in the biopharma market. Our review on CNP. CenterPoint Energy Inc. is an energy delivery company, primarily focused on electric transmission, distribution, and natural gas services across multiple states. It operates in two main segments, electric and natural gas, providing essential services to residential, commercial, and industrial customers. Looking at the stock, CenterPoint has been performing quite well recently. The stock has seen a steady increase, up about 5.44% over the past month and a solid 27.55% in the past year. Today, it saw a slight bump of 0.22%, bringing the stock to $35.75. So, for long-term shareholders, there's a sense of optimism. But for those more cautious about the stock's future performance, a key metric that's getting attention is the P/E ratio. At a P/E ratio of 22.58, CenterPoint stock trades lower than the industry average of 69.68 in the multi-utility sector. This lower P/E ratio might suggest that investors aren't expecting explosive growth, or it could mean the stock is undervalued, offering potential upside for those willing to look beyond the number. While the P/E ratio gives us an insight into how the market views the stock relative to earnings, it's important to remember that it's just one piece of the puzzle. A low P/E might signal undervaluation, but it could also reflect a lack of future growth expectations. To make a well-rounded decision, investors need to factor in other aspects like market trends, the company's long-term strategy, and the overall economic environment. In short, CenterPoint's solid performance has sparked optimism, but the low P/E ratio suggests a bit of caution. If you're looking at this stock, it could be worth digging a little deeper into its future growth prospects and how it stacks up against peers in the industry. Our review on AEP. American Electric Power Company Incorporated is a major electric utility holding company, providing a range of services in generation, transmission, and distribution to over 5 million customers across multiple states. They operate through several segments, including vertically integrated utilities, transmission and distribution utilities, and AEP Transmission Holdco. With a diverse portfolio and operations in key states like Ohio, Texas, and Virginia, AEP is deeply embedded in the U.S. energy landscape. Looking at the stock today, AEP is up by 1.72%, which is a pretty solid move for the company. This kind of gain reflects investor confidence in its ability to provide reliable services across its vast network, especially in the face of broader market movements. Investors may also be reacting positively to the company's well-diversified business model, which gives it a certain level of resilience, even in times of economic uncertainty. What's interesting is how AEP continues to focus on infrastructure development, particularly in its transmission holdco segment, which is all about building and operating critical transmission facilities. With growing energy demand and an emphasis on cleaner energy sources, the company's ongoing investments in expanding and modernizing its grid could drive long-term value. The 1.72% uptick might also be a reflection of the broader market environment, where utilities like AEP tend to benefit from steady demand and a relative safe haven status for investors. Overall, this kind of performance suggests that investors are staying optimistic about the company's growth, especially as it continues to expand its footprint and adapt to changing energy dynamics. Our review on EIX. Edison International is basically the backbone of energy for Southern California, providing clean and reliable electricity through its subsidiary, Southern California Edison. They also have TRIO, a global energy advisory firm that helps companies with sustainability, energy procurement, and all things energy efficiency. Today, their stock is up 1.55%, which is definitely a solid move. It's not surprising, though, given that investors are likely feeling optimistic about the company's focus on clean energy. Southern California Edison covers a massive area, and with the way the market's shifting toward renewable energy, it seems like Edison's in a good spot to benefit from that. Plus, Trio's advisory work in sustainability is a great way to tap into the growing demand for energy solutions that are both green and efficient. This uptick probably reflects that investor confidence in Edison's long-term game plan, especially with sustainability at the forefront. The 1.55% bump shows people are pretty positive about the company's direction. So if you're looking at energy stocks with a focus on the future, Edison might be one to keep an eye on. Our review on EQT. EQT Corporation is a major player in natural gas, with a focus on production and midstream operations in the Appalachian Basin, particularly in Pennsylvania, West Virginia, and Ohio. The company is deep into the Marcellus Shale and Upper Devonian Shale, and it's been doing a solid job of capitalizing on these energy-rich areas. Now, let's talk about the recent developments that investors are buzzing about. Wells Fargo just raised their price target for EQT Corporation to $59, up from $58, and they've kept their overweight rating on the stock. This bump in the price target is based on strong expectations for EQT to report a solid Q1, driven by strong gas prices. They're seeing EQT as well-positioned for steady growth thanks to their firm contracts with power and data center partners. These deals, alongside the company's low-cost, integrated business model, give EQT the ability to expand production sustainably. On top of that, EQT stock has seen some upward movement recently, with analysts generally maintaining a buy rating. Wells Fargo is in the mix with a $59 target, and Jefferies has a similar stance with a $60 price target. The stock is up 1.32% today, and that price movement could signal some growing confidence in EQT's continued success. However, it's not all smooth sailing. There's a bit of negative sentiment coming from insiders, with a notable number of company executives recently selling off shares. While this doesn't necessarily mean the company is in trouble, it's something to keep an eye on as you make your investment decisions. With its strong positioning in the natural gas market and a solid outlook, EQT might be on the radar for those looking for exposure to the energy sector. But, as always, keep an eye on the broader market and insider activity for any shifts that could affect its trajectory. Our review on SO. Southern Company is a major player in the energy space, serving millions across the southeastern U.S. with its electric utilities, as well as natural gas distribution through Southern Company Gas. Beyond its traditional utility services, the company is also deeply involved in power generation, including renewable energy projects, through Southern Power. Now, on to some recent news that's getting investors' attention. Southern Company has just teamed up with the Electric Power Research Institute, or EPRI, to launch a new initiative called the Emerging Technologies Pilot Program. This is a big deal because it aims to fast-track the integration of cutting-edge technologies into the energy sector. The goal is to identify and validate innovations that could help shape the future of affordable, reliable, and resilient energy solutions. By teaming up with EPRI, Southern Company is looking to leverage its vast infrastructure and expertise in energy delivery, while also tapping into EPRI's extensive network of startups working on next-gen energy solutions. The idea is to streamline the pilot process for these technologies, which will not only reduce risks but also speed up the time it takes for these innovations to hit the market. Essentially, they're aiming to bring new solutions to life faster, and that could have a big impact on how they operate and grow in the coming years. With this fresh focus on innovation, investors are seeing potential for Southern Company to stay ahead of the curve as the energy sector evolves. The stock is up 1.32% today, reflecting positive sentiment about this initiative and its long-term impact on the company. If Southern Company can successfully integrate these emerging technologies, it could solidify its position as a leader in the clean energy transition, making it a stock worth keeping an eye on. Please subscribe, give the video a like, and watch more from our playlist. Thanks.